And welcome Rajat Rajgarhia, Director Research with Motilal Oswal Securities. Rajat, morning. Thank you for joining us. Rajat, what do you make of the initial set of numbers which have come out so far? Are the initial numbers above estimates or below your estimates?
Hi, good morning. I think the initial numbers are more or less looks in line, but the diversity of variance is quite high. If you look at specific companies, some of the big names likes of Infosys, TCS, HDFC Bank, all of them have more or less been in line, including Wipro. But I think it's some of the specific stocks where the number variance is significant, likes of Cadila, Crompton, and I think we are just about to start where you will see several of such companies going to report. Initial numbers, large caps looks okay. Within specific mid caps, I think we'll continue to see the problems running well into this quarter.
So Rajat, are you of the view that you would completely avoid stocks like Crompton Greaves, or are you part of the faction of the market that still believes in the management commentary that is that 6 months from now you are sure to see some bit of recovery once the global operations are back in order?
Well, I think right now there is definitely some loss of confidence which has happened for investors. You have seen massive earnings cut happen on the street almost by 20 to 30% for a lot of the analysts. Our own estimates are cut down by 30%. We have been neutral on the stock while the correction in the stock has been very steep. I think investors would like to see at least a quarter of performance. You will see performance returning into the stock only when one quarter of delivery happens. In anticipation, it's unlikely that you are going to see any big performance returning into this name, because this kind of a variance in numbers followed by a big earnings downgrade, these are some very big events and they impact the stock for a long period of time.
Right. Rajat, is there a merit there? Avoid large cap IT stocks, look at mid cap IT stocks. Large cap IT stocks are slowing down and mid cap IT stocks are available at throwaway prices?
Well, I think you need not own mid cap IT stocks at the expense of large cap, because the size in the two companies are very different. This is a sector where the large caps are market cap of 1 lakh crore plus, and the mid caps are market cap of between 1000 to 3000 crores. So they are really not strictly comparable. But in the large cap IT, I think you saw the results where there is some variability in how each company is performing. TCS had another brilliant quarter, Infosys was quite okay, and Wipro was soft. But purely from a valuation point of view, now today you have Wipro trading at 14-15 times FY13 compared to 18-19 times for some of the other large caps. And we think that this is a time when investors can start looking at Wipro. You have the number traction which will start picking up from third quarter for them. You have the valuations which is one of the lowest in the history of the Wipro over the last several years. And you have expectations which have already been set quite low. So within the large cap, we have upgraded Wipro just yesterday itself to a buy. So at this point of time, I think it makes merit to have a relook at this stock at this point.
Watch out for the entire capital goods gamut. Actually, some of these mid caps which have come out with their numbers. So while Crompton, after 2 days of massive selling, is seeing some bit of rebound actually kick in, the other one which is in focus right now is Exide, where the numbers have been bad. The profits have gone down by about 2%, but that is significantly lower than what the street estimates were pegging Exide's numbers to come in at. And the numbers have come down on account of higher lead prices. So Exide as a stock is seeing a significant cool-off kicking in trade, currently lower by about 8.5%. Rajat, what would you do with a couple of these cap goods names, because the results really have been problematic for the space as such?
I think these results are also a reflection of the kind of macro headwinds that we have seen over the last 6 to 9 months. First, you have contraction in demand coming because not just the global economy is showing some signs of slowing down. I mean, in India itself, we have seen GDP estimates cut down from 8.5 to 9 to now 7.5. Second, commodity price inflation has led to a good margin erosion. And when you have demand contraction, then price hikes or passing prices becomes even more difficult. And third, for a lot of the companies which are leveraged, the interest cost for them on a YOY basis could be up by almost 50%. So all the three items of the P&L account, top line slowing down, margin contraction and high interest cost is going to hurt your bottom line. And it's always the psychology of the market that a lower earnings typically ends up getting a lower P. Okay, and this is what we are seeing into a lot of the stocks. And I just wanted to highlight that this is just the beginning of the earnings season. Last quarter, when the March quarter numbers got reported, we had some of the big names that reported numbers, and they saw a sell-off of 10 to 15%, likes of Infosys, State Bank, Tata Motors. There are several names in the large cap. I think this quarter you will see several mid caps where you will see a similar kind of a disappointment coming in, and the markets will react quite wildly. We would advise that don't preempt into buying any stock before the numbers. See through the numbers, see through the management commentary, their outlook, and then only evaluate if one wants to get into any of the names.
Rajat sir, give us 2 or 3 large cap names where you are reasonably certain that you would like to buy them only on a 10% decline, but on a 10% decline you will be a buyer for sure.
Well, we would be a buyer in Bharti because we think that the earnings traction is now going to build up gradually and going to be quite strong for them. So that is one stock. We would be a buyer in Bajaj Auto because we think it has almost all the characteristics of being an FMCG company. You have a stable volume growth, high operating margins, one of the best balance sheets that you can see in the corporate sector, and a very high dividend yield, one of the best dividend yields in the Nifty basket. We would buy ICICI Bank on any correction because we think that the story of ROE improvement from here over the next 2 to 3 years will continue. There may be some near-term headwinds because of some slowing down on the loan growth, but I think the overall story remains quite good. So in the large caps, wherever you see the story panning out quite well, balance sheets remain very comfortable and valuations are attractive. I think now or 10% lower, both prices are good for investors to look into the stock.
Okay, Rajat, appreciate you taking the time out and joining us on the show today. Good to have you as always.